Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Inflation-Linked Bonds, Why Tips Matter for Your Investment Strategy in 2024. Are you worried about how inflation might chip away at your savings? Inflation-linked bonds, known as Treasury Inflation-Protected Securities, TIPS, could be the solution you need. In today's economic climate, where prices seem to constantly rise, understanding TIPS can be vital. These bonds offer a reliable way to shield your investment from inflation, preserving the buying power of your money. As we look ahead to 2024, incorporating TIPS into your investment strategy might be more important than ever. They're designed to adjust with inflation, providing both stability and growth potential. Ready to discover how TIPS can strengthen your financial future? Let's get started. Understanding inflation-linked bonds. In a world where inflation eats away at the value of cash, Treasury Inflation-Protected Securities, TIPS, present a compelling investment option. These bonds, specifically designed to keep pace with inflation, adjust their value to safeguard your purchasing power. Let's dive into how TIPS work and protect your finances. What are Treasury Inflation-Protected Securities, TIPS? TIPS are a unique type of government bond issued by the U.S. Treasury. Unlike standard bonds with a fixed principal, TIPS have a structure designed to keep up with inflation. But how do they do this? The principal value of TIPS adjusts in line with the Consumer Price Index, CPI. When inflation rises, so does the principal of the bond, and consequently the interest payments, as these are calculated based on the adjusted principal. Here are key features of TIPS. Inflation. Adjustment. The principal value increases with inflation and decreases with deflation. Interest payments. Semi-annual payments remain consistent in terms of rate but vary in amount, reflecting changes in the adjusted principal. Protection against inflation. Upon maturity, investors receive either the adjusted principal or the original principal, whichever is greater. So, in essence, TIPS offer a built-in guard against inflation. They're like an automatic shield, adjusting each year based on inflation metrics. How TIPS protect against inflation? The primary allure of TIPS lies in their automatic adjustment mechanism. When inflation hits, most investments lose value. Not TIPS. They increase in worth thanks to their unique structure. How exactly does this work? TIPS adjust their principal every 6 months according to the rise in the CPI. This adjustment directly impacts the bond's interest payments. For example, if the CPI reflects a 2% rise in inflation, TIPS will recalibrate to reflect a corresponding 2% increase in principal. The interest, though fixed in rate, is calculated on this inflated principal, ensuring you earn more as the principal grows. Here's a simple breakdown. CPI monitoring, TIPS, track the CPI to gauge inflation levels. Principal adjustment. Based on CPI changes, the principal is adjusted biannually. Interest calculation. Interest is then computed on the new, higher principal. This adjustment mechanism makes TIPS particularly effective in environments of rising inflation. While stock markets may swing and cash may lose value, TIPS stand resilient, continually adjusting to preserve and even enhance your financial position. As 2024 approaches, keeping TIPS in mind could be a strategic move to maintain your portfolio's health and purchasing power. The importance of TIPS in an investment portfolio. Incorporating Treasury Inflation-Protected Securities, TIPS, into your investment portfolio is like adding a sturdy anchor in choppy waters. They offer a unique shield against the ever-present threat of inflation, ensuring that your financial ship remains steady and on course. Let's explore how TIPS can play a vital role in any investor's strategy, focusing on diversification and addressing varied investment goals. Diversification and risk management. Diversification is the backbone of any robust investment strategy. It's about not putting all your eggs in one basket. TIPS shine brightly in this context, acting as a hedge against inflation. Traditional assets like stocks and standard bonds may not perform well when inflation spikes. But TIPS are designed to thrive under these conditions, making them perfect for balancing risk in your portfolio. By including TIPS, you add a layer of protection that adjusts with the inflation rate. They act like a financial safety net, ensuring that when inflation increases, your returns do too. In essence, they reduce the volatility associated with inflationary periods which typically unsettle other assets. This reduces overall portfolio risk and helps stabilize returns. Consider these benefits. Stability during inflation. TIPS offer returns that keep pace with rising costs. Protection for principal. Even during deflation, TIPS ensure your principal amount is secured. Diversification boost. They perform independently of other asset classes, adding balance to your portfolio. Long-term versus short-term investment goals. One might wonder how TIPS fit into both long-term and short-term financial plans. The beauty of these securities is their versatility. For long-term goals like retirement, TIPS provide security and growth, adjusting for inflation over time. This ensures that when you retire, your money retains or even surpasses its current buying power. In the short term, TIPS can be equally beneficial. They offer a safe haven during periods of economic uncertainty. If you're planning around specific short-term financial events or need a buffer against immediate inflationary threats, TIPS can play an essential role. Here's how they align with different timelines. Long-term security provides inflation-adjusted growth, crucial for retirement savings or future large expenditures. Short-term protection shields against sudden inflation spikes, ensuring your purchasing power remains intact. Ultimately, TIPS are a strategic tool for those who seek both security and potential growth, whether planning for tomorrow or decades down the road. They ensure your investments are not merely at the mercy of market whims and rising costs. Benefits of investing in TIPS. Navigating the investment landscape can feel daunting, especially when inflation is lurking around the corner, ready to chip away at your hard-earned savings. Treasury Inflation-Protected Securities, TIPS, offer a solid countermeasure, ensuring your investment not only withstands but thrives amidst rising costs. Let's break down how TIPS provide a twofold advantage: stable income streams and unique tax implications. Stable income streams. Think of TIPS as your financial safety jacket, adjusting to inflation much like a thermostat maintains your home's temperature. They offer interest payments that aren't just static numbers on paper. These payments rise in line with inflation, which means your income keeps up with the costs you face daily. Here's what makes TIPS an appealing choice for stable income. Interest adjustments. As inflation creeps up, your interest payments don't sit still. They increase with the Consumer Price Index, CPI, ensuring your purchasing power isn't left in the dust. Semi-annual payouts. Investors receive interest payments twice a year, providing a predictable, inflation-proof income stream. Principal protection. At maturity, you get either the adjusted principal or the original one, whichever is higher. This means you're not just earning interest. Your initial investment is safeguarded against inflation. With TIPS, the dread of inflation turning your savings into yesterday's dollars is significantly reduced. They provide a peace of mind that your income will flexibly grow as the cost of living inevitably rises. Tax considerations. While TIPS offer significant benefits, understanding tax implications is crucial for maximizing returns. The U.S. Treasury may have TIPS tax structure designed to keep them attractive, but it's a facet that requires some attention. Interest income taxation. The interest you earn is subject to federal income tax, but is exempt from state and local taxes. This can be a relief if you live in a state with high income tax rates. Inflation adjustment. Taxation. The adjustment to your tips. Principal for inflation is considered taxable income each year, even though you won't receive the actual cash until the bond matures. This phantom income might add a layer of complexity to your tax planning. Maturity and sale. Any gain from the sale of the tips before maturity or the inflation-adjusted principal received at maturity is subject to capital gains tax. Despite these layers, the protection tips offer your portfolio often outweighs the tax considerations. Planning with a financial advisor can help you navigate these nuances effectively. Understanding how tips fit into the tax spectrum allows you to make informed decisions that keep your investment strategy sharp. With the right approach, tips can be a robust addition to your financial arsenal, deftly navigating the ebb and flow of inflation while yielding consistent returns. Risks associated with tips. Investing in Treasury Inflation-Protected Securities, TIPS, sounds beneficial, but it's crucial to understand the potential risks involved. While TIPS are designed to protect against inflation, one must consider other factors that could impact their performance. Let's break down two main risks: interest rate risk and inflation assumptions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.